So I'll just go through a few highlights of the results for FY17 and a bit of a recap for those on the line in terms of who we are. So we're obviously Australia and one of the world's largest toll road operators. We own, operate and develop toll roads in Australia and North America. We've got 15 assets across 4 markets, a market capitalisation currently of around 24 billion, which puts us around number 12 or 13 on the ASX. So that's who we are. In terms of the results this year, again, a very positive result as far as we're concerned. We delivered traffic growth of around 4% and revenue and EBITDA growth of 10.6 and 10.1% respectively. So good underlying results, and I'll go through that a little bit more in a moment. We also provided distribution guidance of 56 cents per share. That'll be an 8.7% increase on the FY17 number should we deliver that in FY18. So again, a solid result. We spent a lot of time this year, and we continue to talk a lot, if you see our investor presentation, around the work that we do in the space around the customer and the technology that supports the customer. And it's been very active in that regard, as well as the development pipeline that we're working through. On a slide in the pack, we go through each of the networks, and again, you can see that we've delivered very solid results across all of those networks. The fundamentals of the business are around traffic numbers, and traffic continues to be very robust across all markets. Price, where we get inflation-linked pricing across each network. And obviously then translating that into EBITDA growth. We did generate EBITDA margin growth across each of our 4 networks, which is a key target of ours, and really solid growth, particularly in Sydney and Brisbane, with Brisbane also benefiting from the full year benefit of the AirportLink acquisition, as you know, that we acquired in April of 16. And then the US business continues to perform exceptionally well, and traffic growth of around 12%. Revenue growth of around 23% and EBITDA growth just under 40% at 39%. So that US model continues to perform exceptionally well. We did have, for those of you in Melbourne, and I'm in Melbourne today, we did have some disruption on CityLink, which saw the traffic numbers down a couple of percent year on year, but we still see the revenue growth, given the inflation-linked pricing, up around 4% and EBITDA up around 5% in that Melbourne market. And we're really happy with how the CityLink Tulla widening project is going. And we're getting towards the end of that with it around 80-odd% complete. So it's been a fantastic project for the company and for the community. Our pipeline continues to be very robust. We still have a development pipeline of about $9 billion across all of our markets. We have, in the most recent period, also reached financial close on the 395 project in the USA, which is effectively an extension of our 95 assets. So the 95 continues along to become the 395 and takes you in, heading north up towards the Pentagon and into Washington, D.C. But the pipeline remains very positive, with quite a lot of noise around the community about 2 major projects that we're looking at. One is one that we're working exclusively on here in Melbourne, which is the Westgate Tunnel project. And then the other one is a project that we suspect we'll be bidding on, which is the New South Wales Government sale of WestConnex, which is expected later next year. The results, again, the statutory results show an interesting set of numbers, largely because of the impact of the AirportLink acquisition on last year's numbers. So we show a net profit of $209 million, or a headline profit growth of 850%, which sounds very exciting, but really what we would prefer to do is get underneath the bonnet of the company and talk to the proportional results. And again, delivering those revenue and earnings results of around 10% year on year, which is the underlying set of numbers. I've already spoken to the margin growth across each of the networks, which has been very positive. And then importantly for us, a very cash-focused organisation, and obviously our distributions are based on the amount of cash that we generate. We generated significant free cash growth during the period, and our underlying free cash coverage, that is the amount of cash that we generate to pay for our distributions, remains at around about 100% at 99.2%. And then finally, the balance sheet. We've done an enormous amount of work around the balance sheet again this year. We've raised $4.6 billion worth of debt, done a lot of early refinancing of the future debt to take any risk of whether it be interest rate increases or anything else off the table, and also get ourselves prepared to support our development pipeline. So we've got a very robust balance sheet, and we feel very confident about that. So with that, again, just a summary of the outlook. Distribution guidance, again, 56 cents for the full year, which would be 8.7% increase year on year, and very much a strong focus around the customer and the development pipeline.